Is there any announcements by the public or contribution by the public? Nobody being here, we'll move on to the Finance Committee meeting. Mr. Samario, would you like to introduce our item?
Good afternoon, committee members. I'm Jill Tara, Treasury Manager, and we have one item on the agenda today. That's the quarterly investment report for the quarter ended September 30th, 2011. Also included in the quarterly report is the fiscal agent report, and that's in attachment 2 to the agenda report. Contained in that shows the balances held at third-party trustees for our project accumulated bond project funds, as well as the police and fire service commission funds that are also managed by a third-party trustee. We'll start the report today with some economic highlights, which probably should have been more appropriately named economic lowlights over the quarter. This was a very tough quarter for financial markets. Financial markets dropped sharply with the worst market performance since the first quarter of 2009 when the recession had first hit and stock markets took a dive. The Dow Jones Industrial Average was down 11.49%. The S&P 500 was down 13.87%, and NASDAQ index was down 12.91%. Investors sold off their stock holdings and sought the safety of Treasury investments, Treasury securities, based on a number of economic shocks that jolted the system this quarter. Early in the quarter, we had slow economic data released nationally, which indicated that the economy was slowing down. There were fears that it would stall out and we could potentially go back into a double-dip recession. That was coupled with the bipartisan divide in Washington over the debt ceiling and the federal government, its abilities to make good on its debt service payments that were coming up, as well as later in the quarter when European debt concerns took the forefront again as Greek default on its debt appeared imminent and the contagion spread to now Italy and Spain. So all of those shocks caused investors to bail out of the stock market and look for safer investments, driving down Treasury yields over the quarter. In an interesting and historic move, the U.S. debt rating was lowered to a AA+ rating by Standard & Poor's, which is one of the three major credit rating agencies here in the U.S. Moody's and Fitch's did not downgrade the U.S. debt. This was seen by investors largely as political commentary on that the political gridlock in Washington. The AA+ is only one notch below the AAA highest coveted rating, and it's the first time U.S. debt has ever been lower than a AAA. But again, seen as largely political commentary and didn't have any effect on Treasury rates that were lower. At its September meeting, the Federal Reserve Bank announced a new stimulus program using not monetary policy as it had in the past, but it's trying to manipulate the Treasury yield curve, the slope of that curve, driving down interest rates in the long run. So it's dubbed Operation Twist, named after the 50s dance. The Kennedy administration in the 60s first implemented a program like this at the time. So they've revived this particular tool as a stimulus program. They're reinvesting the holdings that they have in the 2 to 3 or the shorter end range and reinvesting in the 6 to 30 year range. And they've pledged $400 billion in securities to do this, increasing demand for the treasuries in the long end of the curve and thereby driving down yields. They're hoping that this will stimulate borrowing and consumer spending and entice investors to take on riskier assets than treasuries to stimulate the economy in the short run. At its September meeting, the Federal Reserve Bank also held the federal funds rate flat once again, as it has since the beginning of this recession, at 0 to 0.25%. But rather than just specifying the vague, exceptionally long time, the Fed forecast now is stating that they expect this low interest rate environment to continue until the middle of 2013. So we're in for a long, low ride probably for the next couple of years. With that being said, our portfolio remains stable. Our balances grew over last year, and we continued our investment strategy of rolling over the matured and called securities in the portfolio, repurchasing a portion of that. During the quarter, we had $21.5 million in securities that were called by the issuers before the final maturity date. We reinvested about $18.5 million of that in callable agency securities and $6 million in corporate notes, less than 5 years in term. At the end of the quarter, the LAIF balance was lower by about $11.5 million for an ending balance of $36.5 million. That $11.5 million plus a portion of the called securities in the portfolio was used to fund citywide operations. Our revenues do not come in on a straight line, and we find that the first half of the year we have higher expenses than the revenue that's coming in. That sort of flips in the second half of the year, so that's a normal trend that we do see. Turning to the portfolio performance over the quarter, the overall portfolio yield was down only slightly this quarter by 0.23% or 2.3 basis points to 1.75%. We're seeing that stabilize now over the last few quarters as the higher yielding securities have been called out of the portfolio, and what's driving our yields are the current securities that we're able to buy at current market rates. During the third quarter, we earned just over $717,000 in interest, and year-to-date through calendar year 2011, after 3 quarters, we've earned $2.28 million citywide. We'll turn to the table, which compares our own portfolio yield to our benchmarks, being the LAIF rate, which is an overnight money alternative, the 2-year Treasury, which roughly approximates our target security length, as well as the 90-day T-bill, which would be a LAIF alternative. And this yield, this table, as it does every quarter, looks at a snapshot at the current quarter end for the last 4 years. Now you can see in September 2008, our overall portfolio was earning 4.47%. We had a number of bullets and other corporate notes in our portfolio earning, 4 to 5 and sometimes more than 5% interest that had been bought well before the recession hit. You can tell that this was when the impact of the recession was hitting. Our portfolio normally hovers within a 1% band of the LAIF rate, and already we were 200 basis points over that, or almost double over what the LAIF rate was earning, which had dropped primarily because it's a shorter portfolio. So as the yields drop, it recognized those losses earlier. 4 years later, at September 2011, we're earning 1.75% on the portfolio. The LAIF rate has dropped to 0.38%, the 2-year Treasury to 0.24%, and the 90-day T-bill hovering near zero at 0.01% interest. I brought today a new schedule for you to look at. We talk a lot about Treasury yields and market yields and all, our overall portfolio yield, and I wanted to show what that means for our city in terms of when yields decline, what happens to our income. Now, as you know, safety and liquidity are our primary objectives, so we ensure the safety of the portfolio holdings, preserving the principal, and we yield whatever, or we reinvest whatever's not needed for liquidity purposes for operations out longer term, so that those interest earnings can be programmed for services in our city. Year to date through calendar year 2011, after 3 quarters, we've earned 2.28% or $2.2 million in interest income. For the similar period last year, we earned $2.93 million. And what's interesting to look at is the overall size of the portfolio at the end of each quarter between last year and this year. Our portfolio is higher, but that substantial drop in our yield has meant about $650,000 less in interest income citywide that's no longer being used to program services. That's a 22% drop, and we do expect this to continue again for the next couple of years, although at some point our yield will kind of level out, and that could be in the 1.5% range. So I thought that was an interesting look that less than 0.5% change in our portfolio yield meant a 22% drop in interest earnings over the same period on a higher base. I'll finish up today with the holdings at the end of the quarter, September 30th. Our LAIF account, just being one account now, as the RDA LAIF account was transferred to the city. We held $36.5 million up at LAIF. As you'll recall, the limit is $50 million for each account. The LAIF balance makes up 22.57% of our portfolio. That's probably a little higher than we could keep it, but as you saw on the yield chart, right now, LAIF is earning more than a 2-year treasury. So at this point, we're holding on to a little bit more cash than we probably would in more normal times. We also held a certificate of deposit at Montecito Bank and Trust in the amount of $2 million. Our federal agency issues in the portfolio are just over $105 million. We have a few corporate notes, less than 5 years in term, 5 years in term in our portfolio for $12.25 million. You drop down below the line, we have the airport promissory note. The outstanding balance is $5.9 million, and at the end of the quarter, we had $5.7 million in our bank account at Santa Barbara Bank and Trust, there to cover outstanding checks that had not yet cleared the bank. Our total cash and investments for the portfolio totals $167,478,870. So with that, I'd be happy to answer any questions.
Thank you, Ms. Tara. Questions from the committee members?
Yes.
Ms. Self?
Thank you, Chair. When notes are callable, I'm assuming that we choose those because they're a higher interest rate at the time, but then the issuer has the chance to say, whoops, it's not working anymore. Is that correct?
That's exactly correct. You will see a spread between a bullet, which in this environment can be quite substantial, up to a 0.5% difference. Each security is structured differently, so it'll have a particular call schedule. It can be a one-time call after a year that'll turn into a bullet, and then we'll hold it till final maturity if it's not called. They can be called daily. We call those perpetuals, or it can be called quarterly. And in exchange for that risk of not knowing exactly how long you're going to hold it in your portfolio, that earns a higher interest rate. So that's exactly correct.
Thank you.
Mr. White?
Thank you. Bullet, is that, would you just
A bullet is
clarify what that means?
It's a non-callable security, so it's issued for a particular term, 1 year,
Okay.
2 years, 5 years,
That's
and
non-callable.
we know we'll hold that in our portfolio until the final date.
Okay. And then secondly, the Santa Barbara Bank and Trust, $5 million. There was, as I recall, there's a requirement that the city have money in Santa Barbara Bank and Trust as part of the arrangement for getting for banking services, for lower fees on banking service, some such thing. Could you
That's
remind
correct.
me of what that is?
That's correct. We have a compensating balance, which means in exchange for waiving all fees on the account, as long as our average balance right now over a 90-day period averages $2.3 million, then they'll waive all fees. And currently, just with the float of covering the outstanding checks, we more than accommodate that $2.3 million difference. So there's not a separate savings account that we've pledged $2.3 million. They just look at our daily balance. I will notice or mention that Council approved an extension several months ago to the current banking services agreement. And in exchange for the 2-year extension and waiving the fees, the bank has raised our compensating balance to $4.3 million. But once again, it won't affect how much cash we're holding there because there's usually enough float in the bank account to cover that. So, thank you.
Ms. Tara, you may or may not have a question, answer for this question right off, and that's okay, but I'm curious, is there a measure of inflation, I assume something other than the CPI, that's appropriate for measuring a city's finances? And if so, how would that have compared over the past year to our rate of return on our investment portfolio?
Well, interest rates were negative, or I'm sorry, the CPI, which would be the only measure of inflation. I mean, there's a number of different CPI measures. It was running negative at some points and very, very low. It's returning to the Federal Reserve Bank's target of around 2%. So we're running close to the inflation rate in terms of our interest earnings, but I don't know of a general correlation or using that as a measure, as a typical. We typically measure against other marketable securities
Sure.
rather than a rate of inflation.
I understand that. I'm just curious from a real-world perspective how we're doing against. I mean, we know that many of the things that the city uses, fuel, for instance, have gone up considerably. I'm just curious how we might look at that. But
I'd be happy to bring a chart with that because
Okay.
you do make an interesting point that, to the extent that inflation is increasing, it erodes our buying power. So if we're not even receiving that kind of return on the city's funds, then in theory we're eroding our buying power more quickly than one would appear by just looking at our rate of return.
right,
So,
and I don't, I'm not questioning what we're what
Measuring
we're
it.
doing in terms of investment because obviously we're doing reasonably well for this environment. I'm just curious what the actual results are.
I'll bring a chart like that next quarter,
great.
and we'll take a look at
Okay.
that. Maybe back to when the recession started, or a little bit before, and see what it is historically running, how that tracks. There's
Okay.
nothing to say that on that bar chart too. Every quarter, I couldn't put a line for the inflation.
Okay, great.
Okay,
Thank you very
thanks.
much. Any other questions?
Your question stimulated one of mine.
Sure, Mr. White.
And that is, obviously, the reserves are related to the general fund cash flow, so that's a percent, and that will rise and fall with the budget. However, with the vehicles, for example, that would get back to more what Mr. Francisco is talking about, where those things could be going up faster, or they're going to change in their cost. How does that, and that's a pretty big number, the vehicle reserve is a pretty big number. How is that looked at and measured as time goes by? And there's a bit of return. That the money, for, if I can finish that, then the reserves that are in that account are part of that big
Correct.
number.
Correct.
So they're getting their 1.75%
1.75% interest allocated.
And that sure isn't going to cover the cost of the fire engine.
No, but in
the rising cost
in
of the fire
terms
engine.
in terms of setting rates for each year, when they look at the vehicle replacement schedule, they do make an assumption about what the vehicle will cost at the end of its life cycle, and so you're paying in, and it factors in the rate of inflation into the rates in that pot of money.
But what we don't factor into that calculation is an assumed earnings on those investments or those reserves that those funds have. So they assume, okay, we're going to need this much money, and we're going to adjust for CPI, as Ms. Tar indicated. But if we earn less than our investments, it doesn't hurt them because we don't assume anything that they earn is really on top of that, and then they can adjust rates in the future for that. But we don't assume any kind of earnings like 3 or 4% on the reserves or investments and to build in the rates. We assume zero. So anything we earn is, in fact, just helps in the future reduction of rates. Right.
Yeah, unlike a pension, unlike pension funding, which would factor in some rate of return. Thank you.
Great. Thank you very much. Meeting adjourned.